Nick, your full year results came out this morning. So Nick, what has been the standout of these results from your point of view?
The standout from these results is the resilience and growth in the business despite the top line being soft. We've delivered record profits growth of 8% in adjusted operating profits, increased operating margin and increased cash flow despite our top line sales being 7% lower organically.
Now, the return on capital employed has increased. Do you believe this is going to continue to improve?
Yeah, so we buy businesses for the long term with the intention of growing them ahead of GDP through the economic cycle. And that's what they've been doing. The businesses that we bought over the last 10 plus years are generating, businesses up to 10 years ago are generating returns in excess of 25%. And overall, our organic growth is just approaching 18%. And it's through that long-term approach to growth, organic growth through the cycle.
And what have been the other main headlines for FY25? And what's been happening with revenues and orders?
There was an extended period of destocking following the post-COVID supply chain boom. That led to many customers stocking up internationally to try and offset the shortages of the time. Therefore, they've ended up with too much stock, and they spent the last 18 months bringing those stocks down. And that's why our sales, have reflected. It's been reflected in our sales through that period. So for us, what's been important is to what degree we've been able to mitigate that. Despite a very prolonged destocking in the industry, our sales were actually only down 7% organically. That was principally in the M&C division, which was down 11%. Our Sensing and Connectivity division grew by 1% organically, all in the second half of the year, as that started to come out of that cycle. But through that inevitable cycle, longer than any had expected, but through that cycle, we have been able to manage our growth in profitability, efficiency and working capital, super strong record cash flow, and keep progressing the bottom line, profits, cash flow, margins. And it very much was a case of two halves this year. The first half was really the intensity of the destocking, but actually in the second half we saw quite a turnaround. It's not everywhere, but in most places we saw an improvement. There's more of that to come. We're not fully through it. I'd say we're about 3/4, 75-80% of the way through that. But where we're seeing that, it's starting to sort of flick back quite quickly.
Nick, it would be hard not to mention Trump's tariffs. How's this affecting the business?
So we see fairly limited effect directly from the tariffs. We have an international manufacturing footprint. We can move production around. We currently make a little over half of everything we sell in the US is made in the US, and we could make more there. So we're in discussions with customers at the moment, and we'll do more of that as is required.
So Nick, we've talked about margins. Let's now talk about cash and capital allocation. How's that progressing?
So we have a capital light model. CapEx is around about 1.5% of revenue. It's very cash generative, and these results, free cash flow is up again to just over 40 million, up 9%, with a conversion rate of 106%. So it's super cash generative, and continues to be cash generative through all stages of the cycle. And so we're using most of those. Those proceeds get used really in three ways: some for dividends, some for CapEx, but most of it is used to acquire new investment, to make new acquisitions in equally exciting businesses. So the consequence of that is that we will keep acquiring at the right rate and at the right time, and we're not considering things like share buybacks.
Nick, you've got £80 million worth of firepower. That must create a lot of opportunity for acquisitions. What's the M&A pipeline like?
Very strong. We've slightly changed the focus over the last 3 months, so we've paused on doing any acquisitions which have a particular focus on the US until the tariff situation has settled. So we've got some exciting opportunities in Europe, particularly at the moment, but we still have over 200 opportunities in the development hopper as well. So we're very confident of the opportunity for further acquisitions and just want to get the timing for those deals right.
And ESG, you're making good progress there. Anything in particular that you'd like to pick out?
Well, there are many elements to ESG, but the primary one is carbon reduction. We've been on that path now for around 5 years. Against our 2021 baseline, our carbon emissions now in the calendar year 24 were down 59%. We're well on track for achieving our target of a 65% reduction this calendar year, and we will make further progress to get down to 0 by 2030.
Thanks, Nick. So good strategic progress despite the destocking headwinds. What are your final thoughts?
Well, we think we've delivered a good set of results. It's a strong business and it's delivered growth in all the key metrics, bottom line metrics through this stage of the cycle. And if that demonstrates one thing, it demonstrates flexibility, resilience and a robust business model. And we think we're very, very well set for going forward from here.